Hey Team FG community, Johnny Oconetta here with Carlo Cancino. In this video, we'll be analyzing how much a couple at 63 with $3 million saved can actually spend in retirement and what critical factors that determine whether this money delivers freedom or runs short.
And this sounds like it should be a simple question, but it rarely is, because once you get to this level of savings, the math actually gets a little more complicated, not less complicated.
Yeah, that's exactly it. And through working with clients around this level, we found that $3 million creates some very specific challenges, taxes, CPP and OAS timing, withdrawal sequencing that most people just don't realize until they've actually made the decisions that they can't undo.
So today, we're going to break this down properly. We're going to use an example of a married couple, both 63 years old, with $3 million saved, and showing you what actually determines how much they can safely spend.
So let's get right into it. Let's start with the story of our example couple. So they're married. They're both 63 with $3 million accumulated across RRSPs, TFSAs, and non-registered accounts after successful careers in healthcare administration.
And they built this nest egg through decades of disciplined saving and smart investing. Now they're ready to retire and enjoy all their money.
But despite having what looks like more than enough, they can't figure out how much they can actually spend each year without running into some problems.
One spouse worries about old age security clawback. The other is unsure when to start CPP, and they're both confused about how to withdraw from different accounts without triggering a tax disaster.
So in short, they have $3 billion on paper, but no clarity on what it translates into monthly spending for the next 30 years.
John, I think the core problem is that the portfolio size doesn't necessarily equal the spending power.
Yep.
Taxes, government benefits, and withdrawal sequencing interact in ways that can either protect or destroy wealth.
So they're kind of stuck in between wanting to enjoy their money and being terrified of making the mistake that costs them hundreds of thousands of dollars over the course of their retirement.
Can you imagine? Their wealth was creating anxiety instead of freedom, and they were wasting their healthiest years working because they couldn't figure out how to safely use what they already had.
So with that in mind, let's think about 6 critical questions that they need to ask in order to solve this problem.
Sure. Okay, let's start with question 1. How is the $3 million split across RRSPs, TFSAs, and non-registered accounts? Because this matters. RSPs are fully taxable, tax-free savings accounts are tax-free, and non-registered accounts are tax-efficient. The mix dramatically changes their real spending power.
Now let's think about question 2. What will their CPP and old age security income look like, and when should they start each benefit? Timing is going to affect guaranteed income and how much the portfolio needs to provide. Early CPP reduces your payments, but eases the portfolio pressure. Delaying increases payments, but requires funding in early years from your savings.
What about old age security clawback? That's question 3. How do withdrawals affect it? Well, clawbacks start around $93,000 net income. Without careful planning, they could lose thousands annually, even if everything else is done right.
And think about question 4 with what withdrawal rate does their desired spending represent after tax? So wanting $150,000 per year might require withdrawing $180,000 plus before tax if most funds are in RSPs, a rate that may be unsustainable over a 30-year period.
And what about the fear that many people have right now?
Yeah.
What happens if markets drop 30% in the first 5 years? And this is where sequence of return risk is the silent killer. Early market drops can permanently damage the portfolio if withdrawals are too aggressive.
Absolutely. All very important questions, but question 6 might be the most, is how flexible can your spending be? Flexibility allows the plan to adjust during downturns. So you can temporarily cut some spending, which makes your aggressive targets a little bit more safer in those difficult years.
So once we answer these 6 questions, the path, I think, becomes a little more clear.
So step 1, calculate some after-tax household income. So we look at spendable income for both if both spouses are alive or even if one spouse survives. Portfolio size alone isn't enough.
Get to step 2. You coordinate CPP, old age security, and withdrawals. We smooth out income over decades, sometimes drawing RSPs earlier than expected to maximize the benefit and reduce taxes.
Next is stress test the plan. You model for bad markets, good markets, and average to find a good number that works even when things may not be going your way.
When you take all of these into consideration, it can give clarity on how much they can truly spend without risk of old age security clawback, tax shocks, or sequence of returns disasters. So now that you've seen how this was impacting this couple, this is now the time where we break down how much they can actually spend and how you can apply the same for your own situation.
The starting point is always after-tax income. When a large portion of money is in RSPs, every withdrawal creates a taxable income, which means the spendable amount is always lower than your headline number.
And if you look at it that way, the focus shifts. It's no longer about how much comes out of the portfolio, but how much lands in your bank account after tax.
Yeah. From there, the next piece is coordinating Canada Pension and Old Age Security with these RSP withdrawals. And timing matters because government benefits stack on top of taxable income, and that stacking can quietly trigger higher taxes and old age security clawbacks.
And that's why, in many cases, it makes sense to draw more heavily from RRSPs in the early retirement years before CPP and old age security begin, rather than waiting and creating a really large tax problem later.
After that, the plan gets stress tested. Different spending levels are run through market downturns, average markets, and strong markets to see which one would hold up most over time.
And let's not forget, it's not just about market returns. Income stacking is tested as well, looking at what happens when portfolio withdrawals, CPP, and old age security overlap in the same years.
Now, when all that is combined, you end up with a spending number that's built to last, not based on the best case assumptions, but on what's sustainable and realistic really for the next 30 years.
Right. And that's when a big portfolio finally turns into something useful. It's a clear, reliable spending plan. So, once you understand how account mix, benefit timing, withdrawal rates, taxes, and market risk interact, retirement spending becomes much less mysterious. And instead of guessing, you're making informed decisions together.
Yeah. And if you prefer a more hands-on approach, we're offering a free portfolio analysis. We'll review your savings and accounts to help you determine the type of spending plan that works best for you.
No guesswork.
Yeah.
Just clear insights. Click the link below to start your free portfolio analysis, and we'll see you in the next video.